One of healthcare's most admired compounders just lost more than half its value in a single year. Zoetis, the largest pure-play animal health company on Earth, traded near $159. Today, it sits at $75, yet the business still earns a 28% net margin and $2.1 billion of free cash flow. What actually broke? The answer sits on its own product shelf. The companion animal franchise, the pet medicines behind 2/3 of sales, has stalled. The pain antibody Librela is shrinking, rivals are gaining, and a securities fraud lawsuit now shadows management. Fixable stumble or a permanent breach in the moat? By the end, you will know why the market fled a business still earning 22% on capital, whether the valuation lenses say the sell-off went too far, and the one piece of evidence that would prove the bears right. This is quality on sale, and its single crack. Zoetis sells branded veterinary products across roughly 45 species, from vaccines and parasite treatments to dermatology and pain drugs. It spun out of Pfizer in 2013 and compounded for a decade. Its customers are vets, livestock producers, and pet owners across companion animals and farm animals. The economics are unusually clean. Branded animal health faces no government price negotiation, no insurance maze, and far cheaper, faster development than human drugs, yet still enjoys patent protection and the loyalty of vets who prescribe what they trust. That is why margins run so high. The revenue split makes the risk precise. Companion animals, the dogs and cats portfolio built on Apoquel, Cytopoint, Librela, and Simparica, is roughly 2/3 of sales. Cattle leads the livestock side, then swine, poultry, and fish. This is a pet company with a farm animal side business. The 5-year record looks like a healthy compounder. Revenue climbed from $7.8 billion in 2021 to $9.5 billion in 2025, about 5% a year. Earnings per share grew faster, near 9%. But the trend snapped inside that window. Revenue grew 8.3% in 2024, then just 2.3% the next year. United States companion animal revenue fell 8%, and Librela dropped 13%. A high single-digit grower went nearly flat almost overnight. The margins, though, are reassuring. Gross margin widened to 70.8% on a trailing basis, and operating margin expanded to 37.6%. A franchise truly losing pricing power would show erosion here first. It is not. The weakness is volume and competition, not economics. This is where the quality is unmistakable. Return on invested capital has held between 18% and 22% every year for 5 years, at 21.8% today, against a cost of capital near 8%. That spread of more than 10 points has barely moved. The balance sheet is where management leaned in. Total debt jumped to $9.5 billion, pushing net debt to EBITDA to about 1.8 times, from 1.2 a year earlier. Comfortable for a business this stable, interest covered nearly 15 times. The cash engine keeps running at full power. Free cash flow reached $2.1 billion on a trailing basis, converting over 80% of net income into cash. Capital intensity is light, near 6% of revenue. Reported profits here are genuinely real cash. Capital spending is steady and disciplined, near $600 million a year, about 6% of sales. That light burden has coincided with stable to rising returns, which tells you the plant and research spending is earning its keep rather than quietly diluting the business. The dividend is the disciplined leg. The per-share payout roughly doubled in 4 years to $2.06, growing near 19% a year. It absorbs just 1/3 of earnings, and at today's price the yield sits around 2.7%. Buybacks are where the aggression lives. Repurchases climbed to $3.4 billion on a trailing basis, larger than the free cash flow left after dividends and part funded by debt. Management is betting the stock is mispriced. Shrewd if pet stabilizes, costly if not. Those buybacks show up in the share count. It has fallen from 474 million shares to about 437, nearly 7% of the company retired, and the pace quickened as the price collapsed. Below $80 that either looked shrewd or reckless. Still ahead, whether the valuation lenses call this cheap and the one risk that could break the thesis. But first, what makes this a moat? The return profile. No business lacking a durable edge holds a 10-point spread over its cost of capital for 5 straight years. Zoetis has, on trusted brands, research scale and slow regulatory approvals. But moats erode first at the product edge, and that is exactly where the crack sits. The sector grew close to 9% last year, and rival Elanco posted 15% growth while Zoetis' pet line shrank. Losing share in a growing market is the clearest sign the advantage is contestable. The backdrop makes the fall look self-inflicted. A low beta, cash-generative name with a beta of 0.75 usually re-rates upward when appetite for durable earnings returns. Instead, it collapsed. The problem is inside the company, not the discount rate. The animal health sector itself sits in expansion, not downturn. Growth accelerated across the major players into 2026, with rivals posting double-digit gains. Zoetis is the incumbent losing relative ground, pressured in dermatology, parasiticides, and pain therapies by generics and lighter legacy competitors. Sentiment is scraping the floor. The shares trade barely 4% above their 52-week low and more than 50% below the high. A recent broker note cut its target to $85, warning that product stabilization could be several quarters away. What actually turns this around? Evidence, not hope. Quarterly proof that Librela and dermatology have stopped declining, resolution of the securities lawsuit, and pipeline wins like the new European poultry vaccine. A real livestock offset too small to fix the pet story alone. What is it worth? Discounted cash flow does the heavy lifting because value rests on the durability of the cash, not a re-rating. Grow $2.2 billion of free cash flow at 5%, discount at 8%, and equity lands near $90 a share, a range of 80 to 105. The earnings multiple points the same way. Today, the stock trades just under 11 times next year's expected earnings and 10 times the year after, less than half the market. Apply a conservative 13 to 16 times, and fair value runs $90 to $110. Does the street ask for heroics? No. Consensus sees revenue rising from $9.7 billion in 2026 to $11.2 billion by 2029, with earnings per share climbing from $6.89 to $8.74, 8 to 9% annual growth. Blend the three lenses, adding an enterprise value to EBITDA floor that pegs even a permanently slower Zoetis above today's price, and the fair value band lands around $82 to $105, midpoint near $92. Against 75, that is roughly 23% of upside, if the pet franchise merely stabilizes. That proviso is the whole thesis. The dominant risk is that the pet decline is structural, not cyclical. Watch two thresholds. If gross margin slips below the high 60s or total revenue falls for 2 straight quarters, the moat is eroding economically and fair value compresses toward the low 70s. The lawsuit itself is unlikely to be financially material against a $30 billion company, but it constrains management's ability to reassure the market. Watch credibility. If guidance is cut again on the next print, investors conclude the earlier optimism was systematic and the discount simply persists. The debt-funded buyback cuts both ways. If earnings fall while repurchases continue, leverage climbs and coverage weakens faster than the operating decline alone. Yet the upside is concrete too. If Librela steadies and livestock compounds, buybacks below $80 supercharge earnings per share and the multiple normalizes. Fixable stumble or broken moat. On the evidence, Zoetis looks attractive rather than fairly valued, though conditionally. The franchise economics are intact. 22% returns, 70% gross margins, $2 billion of free cash flow. yet the market prices it at 12 times earnings, implying almost no growth. The single biggest risk is that the pet weakness proves structural, turning slowing growth into outright decline and dragging margins down with it. Until 2 or 3 quarters of stabilization appear in the companion animal line, the gap between what this earns and what its multiple believes stays an open question. This is an educational analysis, not investment advice. Nothing here is a recommendation to buy or sell any security. Do your own research and weigh your own circumstances before making any decision. If this helped you see both the crack and the cash beneath it, subscribe and tell us in the comments which stock we should analyze next. Your suggestions genuinely shape what we cover. Thank you very much for watching, and we'll see you next time.